Hello, everybody, and thank you all for joining us for today's IIF ESG webinar. We hope you're all staying healthy and safe. This new webinar series is designed to promote understanding of the rapidly evolving landscape for ESG disclosure and help with alignment of efforts to measure and track climate finance. So we look at policy and regulatory initiatives, disclosure frameworks like the Task Force on Climate-Related Disclosures, and methodologies for looking at climate risk and portfolio alignment and ESG data provision. So on that note, we're delighted to say, joining us for today's discussion on quantifying the impacts of climate change are Emily Matsukurati, who is founder and CEO of 427, and Jing Zhang, who is Managing Director and Global Head of Quantitative Research for Moody's Analytics. So I'll just open up with a few quick questions for Emily and Jing, after which they'll tell us more about their approaches to quantifying the impact of climate change on balance sheets and cash flows. After Emily and Jing's remarks, there'll be Q&A, where you can submit questions via the Q&A function, and we'll get to as many as we can, but stick to a half an hour for this call. So just a couple of logistical notes before we begin. I want to remind you that the discussion is on the record and there's press in attendance. We're recording it and it will be posted on our website afterwards. If you're joining us via video conference, you can see us, but we can't see participants and participants cannot see each other. If you've got questions, please use the Q&A prompt at the bottom of the screen. If you're on the phone, unfortunately, we can't take phone-based questions. So we'll keep moving quickly and end on time, so let's get started. So Emily and Jing, first of all, tell us, where are you joining us from today and how are you faring in lockdown?
Good morning, Sonia. I think we're both calling from the San Francisco Bay Area. I'm in Berkeley. We're at 7 a.m. here, bright and early.
Thank you so much for that. And Jing, yes, you too?
I'm just across the bay from Emily, San Francisco proper. And as you can see that the sun is shining on me now.
It's a great shot, so thank you. And thank you for getting up so early to join us. So just a quick introductory question. You know, as the pandemic continues to unfold and we continue to evaluate the impact, how is this affecting your work and your clients and the way you do business?
I think I expected climate change to go on the back burner for a little while, and that hasn't really happened as far as I can tell. We see a lot of activity in the market, a lot of banks and financial institutions engaged, looking to continue their work in the space. And I'm sure you've seen a lot of media coverage around the interplay between climate and COVID. So there's a lot to discuss there.
As we go through the next few phases of this pandemic crisis, actually we have been quite dealing with the potential credit risk consequences of this pandemic. And I would also second what Emily just said. The pandemic really heightened people's awareness of tail risk. So we definitely see the heightened interest again in dealing with the potential consequences of extreme events such as climate risk.
Yes, no, we see that across many of our discussions and events as well, including the webinar we had on April 17th with Frank Alderson from the NGFS. So absolutely. So at this point, why don't I hand it over to you to go ahead and get started with your presentation and slides, and remind the audience you can queue up questions as we go along. I'm sure there'll be many.
So today, Emily and I will be focusing on modeling the financial impact of climate change. Let me start with a quick introduction about Moody's expertise in climate risk. Our expertise in this area is both broad and deep, as a result of strategic acquisitions and deliberate investment in research and development. On the acquisition side, Moody's has bought two leading providers in the ESG and climate space. The first one is Visual Aris, which has a broad suite of climate indicators such as carbon emission and stranded assets, and provides detailed assessment of climate governance, TCFD reporting, and climate controversies. The second one is our majority investment in 427, the leading climate data and physical risk analytics provider, funded and led by Emily. Emily will be talking about 427 unique capabilities in this area in a minute. On the organic R&D side, our colleagues at Moody's Investor Service, the rating agency, have done extensive research and integrated a climate change risk assessment into their rating analysis. For compliance purpose, I shall caveat here that neither Emily nor I represent Moody's Investor Service in any fashion. And whatever we say today should not be construed as having anything to do with rating or rating methodology. On the Moody's Analytics side, that's where I sit, we have been focusing on quantifying the economic and financial impact of climate change, working very closely with Emily and her team, as well as our colleagues in Visual Aris and Moody's Investor Service. This large strategic and collaborative efforts has allowed us to develop solutions that span all dimensions of climate risk and help banks, asset managers, insurers, corporations, and other organizations with a wide range of applications, from the TCDF reporting, climate risk assessment, stress testing, to strategic asset allocation and portfolio construction. Today, Emily and I will be talking about the quantitative assessment part of our solutions. With this introduction, let me turn the discussion to Emily.
Just a few words about 427 and about what we do and how this fits in the bigger construct. So 427 headquartered in Berkeley, where I'm calling from, with offices in about every continent right now. We are focused on the physical impacts of climate change, and that means we have developed our expertise in leveraging and extracting processing data from global climate models developed by research institutions around the world, and turning this data into a set of actionable metrics focused on the hazards that you see listed on the screen: heat stress, wildfires, floods, hurricanes, typhoons, sea level rise, drought, and water stress, and finding and assessing with a great level of details the exposure of economic and financial assets. On the next slide, you'll see that we use a wide range of data sets to inform how we look at this complex climate phenomenon. There's climate data, there's also a lot of geospatial imagery, land use data, historical data on weather, data on sea level rise, on storms, data on floods, soil type. Each of the indicators that we work on is constructed with a set of different metrics that are anchored in the physical reality of this world, essentially. So when we look at heat stress, for our clients who look at a very specific property, location, corporate facility, underlying asset that may be part of a deal, we're going to be looking at specific changes in temperature, changes in extreme precipitation. We're going to look at return period for floods, for coastal and inland floods. So really trying to tie the scores and provide a synthetic, easy to access view, but tying it and providing the specifics of what are the physical measurements that are driving the score that we give to the asset. And on the next slide, you'll see we've learned through years of experience, having started this many years ago before climate change was cool, that we need to be we need to really provide an entry point that's easy to access. So simple colors, green, yellow, red. It's easy for anybody without any background on climate change or on our methodology specifically to understand which asset may be at risk. What is the risk that is driving exposure for this asset? And at the same time, the way we built our, sort of Russian dolls, right? You can keep opening if there's something red or any color, but any risk any risk score can be expanded to understand what are the drivers of this risk. The other key thing that we do and focus on, and I think that's an important element of feeding into how we're working now with Jing and his team, is that any asset that we look at, we're very consistent in that we're always going to look at the exposure across the same range of risk with the same indicators, so that exposure can really be compared and understood on the same set of scales and indicators. So looking at the next slide, this approach that we have of understanding risk from a very granular perspective is then applied to understand the exposure of listed companies by looking at the risk for each of their facilities. So we work with a number of databases that provide us an indication of where corporate facilities are located. In this map, in the example, I displayed facilities from a number of manufacturers in Japan and Southeast Asia, and specifically their sites that are coastals and which sites are exposed to sea level rise. So it gets very granular, but that means an investor or bank looking at a set of companies of interest can look at which companies has the greatest exposure to sea level rise, specifically what percentage of their facilities might be exposed, what type of facilities, in which country they have the most exposure, and so forth and so on. And so this data is really useful both for engagement, but also for a quantitative approach of understanding what the impacts might be of those risks when they start manifesting more systematically. The other thing I'll note here is that for corporation, risk goes beyond exposure in the operations and the facilities themselves. There is risk in the extended value chain, both upstream in the supply chain, downstream in terms of market, and all of this exposure is mitigated by how the company is responding to this risk. Is it aware? Is the board, is the leadership engaged on those issues? What are the measures that they're putting in place? And that we are starting to get a little more visibility in. And so we now have an indicator, thanks to our colleagues at Vigeo Iris, who have specialized on collecting reported data. We now have the ability to also compile these exposure indicators that we provide with a view of how the company is managing this risk, which gives us a very holistic view of how corporations are managing their exposure to climate risk. Before turning it to Jing, I'll just say a few words about how we're working with Moody's. And as Jing noted is in opening, we're not speaking on behalf of Moody's Investors Service, but we do get the question a lot of how is this data integrated. And on the credit rating side, there has been a couple of research reports that are published already on looking at heat stress in municipal credit risk in the US, power utilities, scenario analysis, and there's more in the pipeline. And then the work with Moody's Analytics, Jing will tell you more about the joint solutions that we're developing. We're also working with a number of other parts, including joint solutions for real estate with the REIS network. So a lot of exciting work for us. Jing, I'll turn it back over to you.
How do we turn the climate risk factors into financial risk metrics? So we can do this by first recognizing that the main risk drivers that we're used to are really impacted by climate risk. And this journey of the translation from climate risk to concrete financial matrix is usually based on a scenario analysis that start with whether it's a physical risk scenarios or transition risk scenario. On the physical risk scenario side, usually include extreme weather events or gradual climate changes. On the transition side, you can specify what may happen on the political policy action, technology change, or consumer preferences. The second step is taking these scenarios of physical and transition risk and assess the economic consequences. And this step is depicted in the second step. So for example, the realization of physical risks such as extreme heat, flooding, wildfires, etc., may lead to business disruption, asset destructions, and loss in productivity. While the transition risk may result in higher energy prices, lower value of stranded assets, and potential reconstruction and replacement of assets. Based on the assessment of what may happen at the economic level, we can further assess the next step, which is the financial impact. So the financial impact there are two aspects to this at a high level. One is the cash flow and the business risk of affected entities. And this is impacted by physical and transition risk. Another aspect is the potential change in capital value as well as risk premium, impacted by the change in asset valuation. Now, for those who are well schooled in credit risk assessment, you notice that there are 3 C here: cash flow, collateral, and capital, which will affect borrowers' credit risk profile. That will get to our next step of the translation, which get us to the risk matrix. At this step, we can group the financial metrics into 2 categories. First is at single corporation level. And here's matrix that we're all familiar with are probability of default, loss given default, internal and external ratings, expected loss, spreads, and all these should be adjusted by the climate risk consideration. We can also derive these metrics at the portfolio level. And these metrics are about measuring concentration, correlation, impact, value at risk, and tail risk. So this is the 3-step framework based on scenario analysis, turning climate risk assessment into financial metrics. How exactly we can carry out this analysis? Let me give you a more concrete example. Looking at the transition risk and its impact on cash flows and the credit matrix. So first, as we mentioned, you start with whether it's a physical or transition risk scenario. In this case, it's a transition risk scenario. For example, you can specify what may happen to carbon tax, technology preferences, consumer preference shift, and you can specify specific values to describe these scenarios in a certain model setting. The second step is looking at what may happen to the general economy. And here, linking from the transition risk scenario to the impact on economy, usually we would deploy some sort of integrated assessment model. In this specific case, we're depicting a global sectoral economic impact model, where you can describe the impact on a number of sectors. So for illustrative purposes, we have listed the effect on fossil fuel energy sector, effect on utility sector, effect on auto, renewable energy, and other sectors. And further, the model would give you potential impact of on the revenue and expense side. So for example, in this specific case, we have listed potential impact on revenue. Once you have the impact at the region and the sector level, you can further take that to the firm specific level. So the next level will be assessing impact on specific firm's cash flow and by looking at the revenue and the cost. And this aspect is very much like a basic corporate finance type of analysis, looking at the impact on the balance sheet and income statement, and analyzing the assessment from the economy and the sector level to firm specific level. Once we have done this part of assessment, we can further translate that into the credit risk impact on these borrowers. And the end results will be the probability assessment. And here I've listed expected default frequency, and that's our specific terminology for probability of default. And the resulting impact would be the probability of default and what may happen to the equity value, the asset volatility, that's a reflection of business risk, as well as what may happen to the bond and the loan value and the potential impact on implied ratings. Now, let me get a little bit more specific on the last step, the translation from the corporate level analysis to the credit risk assessment. And here, we're basically leveraging the well-known the industry standard structure, so-called structure model framework for assessing corporate credit risk. The basic idea is that a firm's credit risk is determined by comparing its asset value to its default point. That's how much they own. If the asset value is lower than what it owns, which is its default point, then the firm may get into default. So the graph you are seeing basically depicting the various possibilities of the asset value migration over time relative to its default points. The blue pathways are basically a depiction of the possibilities of potentially negative impact from climate change on the asset value passes. So in this specific case, we're describing a scenario that the climate risk, the transition risk part of this negatively impact the asset value. As a result of that, we'll see higher degree of default risk. And how exactly we do that is by, again, starting with the scenario. In this case, we're talking about transition risk. And then we assess the impact on the equity value of the borrower and asset volatility and the liability, which is how much they owe to the external parties. And going through these three drivers, we can assess the market value of assets by deploying our option theoretical framework, by recognizing that equity value is a core option on the underlying assets. And that's where the structure model framework comes in. And the economic theory behind that is the Merton and Black-Scholes framework, and which is well established in the modern finance. By looking at the market value of assets comparing to the default points and scaled by the standard deviation of asset value, we get the distance default, which basically measure how far away the company is from financial stress. And with this process, we arrived at finally the climate risk in this specific case, the transition risk adjusted expected default frequency. Once we have that, we can further translate that into the evaluation of the bond and look at the term structure of the credit risk profiles and potential impact on implied ratings. So that's the structure model framework we use in translating the last step from the corporate finance level type analysis to the credit risk profile and bond value. So that's the example of how we potentially can conduct the risk of transition risk. Now let me so I provided quite a bit of level of detail here, and there's a lot to digest. We'll be happy to provide further details for those of our interest. Now let me bring back the conversation to a higher level. And I want to make a few quick comments. This is a very much a multi-disciplinary approach to all the major asset classes. And we like to joke that this is very much an endeavor of a collaborative coalition of willing and able scientists from climate science, energy science, economics, financial risk modeling. And in doing so, we're very much are guided by the design principle for decision usefulness. And the principle there, we stick to we need to make sure the framework is dynamic, transparent, robust, modular, and configurable. And we take these principles and using the collaborative approach, we cover all the major asset classes, whether we already have methodology or in active development phase. So this includes corporate as residential, as well as infrastructures. In doing so, we very much take a portfolio and balance sheet based approach.
Thank you so much, Jing. That's a super informative. I just wanted to interrupt briefly because we do have a number of questions piling up. So just a couple of quick ones. On a broad view, first of all, How do you think about a company where the direct assets are well located to avoid physical risk, but their countries where they reside are very exposed to risk? So that's one. Also, on a general note, how do you incorporate increased pandemic-related risks? So referring to kind of non-climate risks related to deforestation and the transmission from animals and so on. And the third is quite a practical question. Are climate-related exposure indicators at the property level available worldwide? So I'll leave you with those.
All right, why don't I take a quick stab at those? I'll start from the end. So the physical risk assessments and the data that we have is available for every point on the planet. So that's a key part of the work that we do, is making sure that it's all comparable and assessed on the same, using the same metrics, the same underlying data. When this question of specific location exposure versus more macro exposure is also really important, and that's something that we factor in by also having a view of risk at the country level, and that's part of how we score both assets for a corporation and looking at a company. We also provide, when we do, say, real estate assessments, where we'll be looking at specific properties, maybe for cities in the US, detailed benchmarks on how that property compares compared to how that property performs compared to the rest of the real estate stock in that MSA, in that metropolitan area. And the last one, quickly, we're not explicitly modeling pandemic. There is a lot of work done by our colleagues in terms of pandemic and ESG at Vigeo Eiris. On the scenario analysis part, this factors in for us by thinking about what are the lessons learned from the crisis that we're currently experiencing, and what does this mean, for example, to look at what's happening with airlines and thinking about what might an extreme transition shock look like in terms of seeing air traffic collapse and oil prices collapse in ways that were maybe not even thinkable a few months ago.
I think that actually gets to another question we've had, which is how you would incorporate scenarios being done in the official sector, like the NGFS and Bank of England. So I think you've commented on that. One last question. Can you model physical and transition risk at the same time in one climate-adjusted EDF score?
Absolutely. The slides I just showed include both the physical and transition risk, even though I focused the discussion on the transition risk. So in the same framework, yes, you can accommodate both.
Great. Well, I do wish we could continue, and I think we will have to have you back for a continuation of this discussion. But thank you so much, Emily and Jing, both for being here today. We very much appreciate it. We'll have this up on the website afterwards. And that concludes our webinar for today. Thank you very much.